We are about to learn a trading concept that can completely transform the way you trade if you truly understand it. This concept is called multi-time frame analysis. In this video, I'll show you how to analyze the market from higher time frames down to lower time frames, allowing you to make more informed trading decisions. So first, let's understand what multi-time frame analysis actually is. It is a method of analyzing the market where you begin with the higher time frame and gradually move down to the lower time frames. This process involves three important time frames. The first is the direction time frame. This is used to identify the overall market direction. You simply determine whether the price is moving up, moving down, or ranging sideways. This gives you a clear picture of the overall trend. The second is the behavior time frame, where you study how the price is behaving in greater detail. Here, you analyze momentum, market structure breaks, wick rejections, doji candlesticks, and whether the market is retracing or continuing its move. The third and final is the entry time frame, where you actually execute your trade. If the market is in a downtrend, you'll look for selling opportunities. If it's in an uptrend, you'll look for buying opportunities. It's that simple. The time frames you use depend entirely on your trading style. For example, since I combine intraday and swing trading, I use the 4-hour chart to identify direction, the 1-hour chart to study market behavior, and the 15-minute chart for trade entries. However, if you're a scalper, your time frames will be different. You might use the 1-hour chart for direction, the 15-minute chart for behavior, and the 5-minute chart for entries. So always remember, your time frame selection should match your trading style. I've given you these examples so you can choose the right combination for your own approach. Now let's begin our multi-time frame analysis. The first thing we'll do is switch to the 4-hour chart to determine the current market direction. The biggest advantage of using the 4-hour time frame is that it clearly reveals the overall market structure. If we were looking only at the 15-minute chart, it would be difficult to identify the real direction because the price constantly moves up and down. That's why higher time frames provide a much clearer perspective. Many of you might look at this chart and feel confused. You may wonder whether you should buy, sell, or avoid trading altogether. But that's the wrong way to analyze a chart. As intraday or swing traders, we don't need to focus on very old price action. Instead, we should pay attention to how the market has been behaving recently. If you keep marking every historical support and resistance level, your chart will become cluttered with lines, making it much harder to make trading decisions. Just imagine trying to analyze price action with dozens of lines covering your chart. On the 4-hour chart, we can clearly see that the market is still in a strong uptrend, and the price is currently consolidating. The first thing we'll do is mark the high of the consolidation zone, followed by the low of the consolidation zone. After drawing these two levels, we'll simply wait. We'll allow the market to decide its next direction. At this stage, the market can either continue its uptrend or reverse and move lower. If I were trading this setup live, I would wait for a 4-hour candle to close outside either of these levels before deciding whether to buy or sell. After a few candles, the price closes below the previous consolidation low. This is where many beginner traders immediately enter a sell position. But I want you to pay close attention to what happens next. The very next candle forms a large bullish candle. Now listen carefully to what I'm about to explain, because this single concept can completely change your trading style. Here's a powerful tip, completely free. Right now, we're looking at the 4-hour chart, where the market is clearly in a strong uptrend. However, as soon as we switch to the 1-hour chart, we notice that the price is gradually moving downward. And when we move further down to the 15-minute chart, it actually looks like a strong downtrend. At first, this may seem confusing. How can the 4-hour chart show an uptrend while the 1-hour and 15-minute charts show a downtrend? Here's why. The recent candles on the 4-hour chart are simply forming a retracement or pullback within the larger uptrend. When you zoom into that pullback on lower time frames, it naturally appears as a downtrend. Always remember one important rule. The higher time frame trend is always more powerful than the lower time frame trend. In this situation, the 4-hour trend carries more weight than both the 1-hour and the 15-minute trends. Likewise, the 1-hour trend is stronger than the 15-minute trend. That's why we always trade in the direction of the higher time frame trend. Since the 4-hour trend is bullish, we're only looking for buying opportunities. Now we're on the 15-minute chart. But we are not going to buy immediately because the short-term momentum is still bearish. Instead, we'll wait until the 15-minute chart shifts from a bearish trend to a bullish trend. Only then will we consider entering a buy position. So far, the market hasn't given us any bullish confirmation. Therefore, we continue to wait. The price retests this level, but fails to break through it and moves lower again. The same thing happens once more, telling us that the market has now entered a sideways phase. Before entering a buy trade, we need the price to close above this level and establish a bullish market structure. If we switch to the 1-hour chart, we can see that there is still no bullish confirmation that justifies entering a buy trade. After a few more candles, the price drops to the previous swing low, finds strong buying pressure at that level, and rallies sharply upward, forming a large bullish candle. The trend line has now been broken. However, we are not entering the trade on the 1-hour chart. Instead, we switch back to the 15-minute chart. At this point, we can confidently say that the short-term momentum has shifted from bearish to bullish.